November 26th, 2025. Circle that date, underline it. Because that single day could completely reshape property ownership in the United Kingdom as we know it. Right now, as you're watching this, 1 in 5 homeowners across Britain have put their moving plans on ice. They're not looking at properties, they're not calling estate agents. They're sitting tight, paralyzed by uncertainty, waiting to see what Chancellor Rachel Reeves pulls out of that famous red box. And the rumours swirling around Westminster, they're absolutely wild. We're talking about the complete abolition of stamp duty, mansion taxes on family homes, and new levies that could hit landlords so hard it triggers a mass sell-off that makes the current exodus look like a trickle. The property market hasn't just slowed down for its usual pre-Christmas lull. It's gone into full hibernation 6 weeks early, and estate agents are reporting the quietest autumn in years. Why? Because what's at stake here isn't just a few £1,000s in tax. It's your home, your wealth, the legacy you plan to leave your children, and potentially your entire financial future. Before we dive into exactly what might happen on Budget Day, if you want to stay ahead of every major property announcement and housing policy change in the UK, make sure you hit that like button and subscribe to Property Reporter. We break down the latest UK property and housing news so you don't have to wade through government jargon and financial speculation. Right, let's get into what November 26th could mean for you. The biggest bombshell rumour that's been doing the rounds since August. Stamp duty could be completely scrapped on Budget Day itself. Now, before you start celebrating, here's where it gets interesting. The Treasury isn't just considering abolishing it out of the goodness of their hearts. They're modelling a replacement that could be far more expensive for millions of homeowners. According to leaked reports, officials have been asked to study a new proportional property tax on homes worth more than £500,000. But here's the kicker. Instead of paying stamp duty once, when you buy a property, you'd pay this new tax annually after you sell, every single year. The proposed rate, around 0.5% annually, with an extra 0.25% on values over £1 million. Now that might not sound like much, but let's do the math on a £750,000 home in the southeast. Under the current system, you'd pay stamp duty once when buying, around £25,000, and you're done. Under this new system, if you live there for 20 years and then sell, you'd start paying roughly £4,000 every year for as long as you own it after the sale. Over 2 decades, that's £80,000 instead of a one-time £25,000 hit. Here's what makes this particularly brutal for certain areas. Only about 20% of property sales are for homes over £500,000 nationally, but in London, that's the majority of transactions. In the southeast, a massive chunk. These aren't oligarch mansions we're talking about. These are 3-bedroom family homes in Hertfordshire, semi-detached houses in Surrey, ordinary properties that have simply benefited from decades of house price growth that nobody asked for. And there's historical precedent here that should worry anyone with a property transaction in the works. When stamp duty changes have been announced in previous budgets, they've taken effect at midnight on Budget Day itself. No warning, no grace period. If you're mid-chain when Reeves stands up on November 26th, you could find the rules have completely changed by the time she sits down. Estate agents are already reporting that some buyers are pushing for contracts that give them flexibility to pull out if the budget brings nasty surprises. Others are scrambling to complete before the 26th, just in case. But stamp duty is just the start. There's another tax reform lurking in the background that could hit even harder, and most people haven't even heard about it. Council tax. Now, you might be thinking council tax is boring, predictable. That bill you pay every month without thinking twice. But here's the problem that's got the Treasury's attention. Council tax bans were set in 1991. Think about that for a moment. Your home is still being taxed based on what it was worth when the Soviet Union still existed. That £150,000 house from 1991. It's probably worth £400,000 now. That £200,000 property could easily be £600,000 today. And in London and the South East, the gap is even more absurd. The Treasury is seriously considering a complete overhaul that would base council tax on current property values. Some think tank proposals suggest a new local property tax with a minimum annual bill of £800 that would rise in proportion to your home's actual value today. Not what it was worth 3 decades ago, today. For homeowners in high-value areas, this could mean their annual council tax bills double or even triple overnight. The Institute for Fiscal Studies has gone even further, pushing for double council tax rates on higher-value properties. And here's why this is politically explosive. The last time a government tried to fundamentally reform local taxation in Britain, it was Margaret Thatcher's poll tax. That ended with riots in the streets and played a major role in bringing down her government. Rachel Reeves knows this. Everyone at the Treasury knows this, but they're modelling it anyway because the government needs revenue and property wealth is sitting there, largely untaxed, growing year after year. The question is whether they'll actually have the courage or the foolishness to pull that trigger. Now, if those 2 changes weren't enough to worry about, there's a third rumour that's got homeowners in expensive areas genuinely panicking: a mansion tax. But this isn't some levy on oligarch penthouses in Knightsbridge. The version being discussed would slap capital gains tax on the sale of your primary residence, something that has literally never been taxed in modern British history. Your family home has always been CGT-free. It's been a sacred principle of UK property ownership. Until now. The rumoured threshold is £1.5 million. Now, if you live in Manchester or Birmingham or Glasgow, that probably sounds like a fortune. But in large parts of London and the South East, that's just a normal family home. The average property price in London is already over £500,000. And in boroughs like Westminster, Kensington, Camden, we're talking about average prices well into the millions. So this isn't targeting the ultra-wealthy. It's targeting ordinary families who happen to live in areas where property prices went through the roof. Under the proposed system, basic rate taxpayers would pay 18% capital gains tax on any gain above the threshold. Higher rate taxpayers would pay 24%. Let's run through a real example. Say you bought a house in Wandsworth in 2000 for £300,000. Today it's worth £2 million. That's a £1.7 million gain. Under current rules, you pay nothing when you sell because it's your primary residence. Under this rumoured mansion tax, you'd pay CGT on the £500,000 above the £1.5 million threshold. At 24%, that's a £120,000 tax bill just for selling your family home. For most people, that's not spare change they have sitting in a bank account. That's multiple years of salary. That's retirement savings. And because it's capital gains tax, it's due on paper wealth, not actual cash in hand. You'd have to find that £120,000 when you sell, even though you never had that money until the sale completed. Critics are calling this a stealth wealth tax, and they're not wrong. It's a way of taxing property wealth without actually calling it a wealth tax. If you're a landlord watching this, you're probably thinking, things can't get any worse for you. Well, brace yourself. There's yet another proposal specifically targeting rental income, and it could be the final straw that pushes tens of thousands more landlords out of the market entirely. The Treasury is considering applying national insurance to rental income. Currently, rental profits are treated as investment income and escape NI entirely. Under the new proposal, landlords would pay 20% NI on basic rate earnings and an additional 8% on income above roughly £50,000. That's a potential 28% NI charge on top of income tax. Let's add this up for a landlord with a £300,000 buy-to-let property bringing in £18,000 annual rent. After mortgage interest, maintenance, letting fees, insurance, they might clear £6,000 in profit. Under current rules, they pay income tax on that. Under the new proposal, they'd also pay NI. For a higher rate taxpayer, that's an additional £1,680 gone, leaving them with just over £4,000. That's barely a 1.5% return on a £300,000 asset, before accounting for void periods or major repairs. This comes on top of Section 24 tax changes that already wiped out mortgage interest deductions. On top of stamp duty rising from 3% to 5% on additional properties. On top of capital gains tax allowances being slashed from over £12,000 to just £3,000 in recent years. And on top of the Renters' Rights Bill making it harder to remove problem tenants. Recent data shows that 41% of landlords are already planning to sell at least some properties in the next year. Nearly 16% of all properties currently for sale are former buy-to-let investments. That's the highest rate in years. If this national insurance proposal goes through, we could see a genuine stampede for the exits. And here's the cruel paradox. The government says it wants to help renters, but every landlord who sells reduces the supply of rental properties. And we already know what happens when rental supply drops. Rents go up. The National Residential Landlords Association is already warning that landlords selling up is the single biggest challenge renters face in 2025. Average UK rent is now over £1,300 per month, up nearly 9% in just 1 year. Demand still massively outstrips supply, with 12 inquiries per property compared to just 5 before the pandemic. Only 1 in 8 renters can actually afford to buy a home where they currently live. So policies designed to squeeze landlords end up hammering the very renters they're supposed to protect. But it's not just about what happens to your property while you're alive. The budget rumours also extend to what happens when you die, and the inheritance tax changes being whispered about could fundamentally alter how families pass on wealth to the next generation. The inheritance tax threshold has been frozen at £325,000 since 2009, and it's staying frozen until 2030. But the rumours suggest the Chancellor might go further. One proposal would extend the 7-year gifting rule to 10 years. Currently, if you give money or assets to your children and survive for 7 years, it falls outside your estate for IHT purposes. Extending that to 10 years means more gifts get caught in the tax net when someone dies unexpectedly. Another proposal would introduce a lifetime cap on tax-free gifts, fundamentally limiting how much you can pass on to the next generation without triggering the 40% inheritance tax rate. But the really big one, the one that would affect middle-class families most, is the potential removal of the residence nil rate band. That's the extra £175,000 allowance that applies when you pass your home to direct descendants. For married couples, the current system allows up to £1 million to be passed on tax-free when you include the family home. Removing the residence nil rate band would slash that to just £650,000. For context, the average UK house price is £270,000. But if you've got a home in the southeast worth £500,000, a modest pension pot, some savings, and a life insurance policy, you're easily over that £650,000 threshold, 40% tax on everything above it. And remember, from April 2027, unspent pensions will be included in your estate for IHT purposes. That's already been announced. So the estate that might have squeaked under the threshold before could suddenly be hundreds of thousands over it. For many families, their home is their main asset, the thing they plan to pass on so their children could get on the property ladder in an impossibly expensive market. These inheritance tax changes would take a huge bite out of that before it ever reaches the next generation. So, with all these rumours flying around, what's actually happening to the property market right now, in real time? It's freezing. Zoopla's latest data shows buyer demand is down 8% compared to last year. Sales agreed have dropped 3%. That's the first annual decline in sales agreed in 2 years. Properties are still coming to market. In fact, supply is up. But buyers are sitting on their hands, waiting to see what November 26th brings. Nearly 40% of prospective buyers say they're worried about whether they'll be able to afford stamp duty obligations if the rules change. And it's hitting the upper end of the market hardest. Properties over £500,000, exactly the ones most likely to be affected by these rumoured changes, are seeing the biggest slowdown. In some areas, this autumn slowdown started 6 to 8 weeks earlier than usual. Estate agents are reporting viewings drying up in October when they'd normally stay strong until mid-November. The market has essentially gone into hibernation, and it won't wake up until Budget Day provides some answers. There's a genuine dilemma for anyone who needs to move right now. Do you push to complete your transaction before November 26th, just in case changes take effect at midnight? Or do you wait, hoping that the changes will be less severe than the rumours suggest, or might even benefit you? If you're buying a £600,000 house in the southeast and you complete before the budget, you'll pay around £20,000 in stamp duty under current rules. But what if stamp duty is abolished the next day? You've just handed over £20,000 you didn't need to. On the other hand, what if it's replaced with something worse, and you end up paying more over time? What if you're selling and a mansion tax gets announced at midnight, suddenly slapping CGT on your sale that you never budgeted for? The uncertainty is paralysing, and that's exactly what's causing this market freeze. Here's the big question underlying all of this speculation. Why is the Treasury even considering such radical property tax changes? The answer comes down to one number: £40 billion. That's the fiscal gap the government needs to fill, according to think tanks analysing the public finances. Government borrowing hit £18 billion in August alone, a 5-year high. Over the first 5 months of the financial year, borrowing reached nearly £84 billion, more than £16 billion higher than the same period last year and well above predictions. The Chancellor has committed to fiscal rules requiring debt to fall as a share of GDP while keeping day-to-day spending balanced. But growth is weak, inflation is proving sticky, debt interest costs are high, and spending commitments on the NHS, defence and other priorities keep rising. Labour made a clear manifesto pledge: no increases to income tax, VAT or national insurance for working people. Rachel Reeves has already raised £40 billion through other measures in her first budget last year, including changes to employer national insurance and capital gains tax on non-property assets. She said she doesn't intend to repeat that scale of tax rises, but the money has to come from somewhere, and that's where property comes in. The UK has enormous property wealth, much of it accumulated through decades of house price growth that had nothing to do with the homeowners' efforts. It just happened because supply couldn't keep up with demand. For the Treasury, this represents a massive pool of largely untaxed wealth, especially for owner-occupiers whose primary residences escape capital gains tax entirely. From a pure revenue-raising perspective, it makes sense to target it. But there's a massive political problem. Homeowners vote. Property owners are a huge chunk of the electorate. And while Labour pledged not to raise taxes on working people, the definition of working people apparently doesn't include anyone who owns property or has investments. The government needs revenue without breaking its manifesto promises, and property taxes are one of the few levers left to pull. That's why these rumours exist. That's why the Treasury is modelling all these options. Whether they'll actually have the political courage to implement them is a completely different question. Now, before you panic and assume everything you've heard in this video is definitely happening, let's talk about what probably won't happen on November 26th. First, a full-blown wealth tax on assets over £10 million. While some think tanks and Labour backbenchers have pushed for it, claiming it could raise £24 billion a year, the international evidence is terrible. 8 countries have tried wealth taxes, only 4 still have them. The rest scrapped them because they didn't raise the expected revenue. They drove wealthy individuals abroad, and they were expensive and difficult to administer. It's politically toxic and practically problematic, unlikely to happen. Second, complete stamp duty abolition without any replacement. Stamp duty raised over £11 billion last year. The government cannot afford to just lose that revenue. If stamp duty goes, something else will replace it. Third, immediate implementation of a full council tax revaluation based on current property values. That would require a massive administrative exercise, new valuations for every property in England, new legislation, and would probably trigger a political firestorm. If it happens at all, it'll be phased in over years, not overnight. Fourth, retrospective taxes on properties where stamp duty has already been paid. The think tank proposals guiding Treasury thinking specifically say the new property tax would only apply after future sales, not properties purchased under the old system. Fifth, any emergency changes without consultation periods. Major tax reforms, especially ones affecting millions of homeowners, typically go through consultation processes, debates, committee stages. They don't just appear and take effect overnight, unless it's something simple like a rate change. And finally, anything that would cause an immediate property market crash. The government knows the property market is crucial to the wider economy. Construction, finance, consumer spending on home improvements, all of it ties back to a functioning housing market. They're not going to deliberately crash it. So while the rumours are serious and the Treasury is definitely modelling these options, the most extreme versions are unlikely to happen, at least not immediately. But let's be clear about who wins and who loses if even the moderate versions of these proposals go through. The winners? First-time buyers purchasing homes under £300,000 would genuinely benefit if stamp duty is abolished and not replaced at that price level. That's most of the North, the Midlands, parts of Scotland and Wales. For them, this could be a real boost. People planning to stay put long-term also win. If the new property tax only kicks in after you sell, those who aren't moving for decades won't be affected anytime soon. And property owners in lower value regions generally come out better because the thresholds being discussed, £500,000 for the new property tax, £1.50 million for the mansion tax, are well above what most homes outside the South East are worth. Now, the losers. Anyone with property over £500,000 in London and the South East is facing potential tax increases on multiple fronts. Landlords facing yet another hit on top of all the previous tax changes and regulatory burdens. Many are already losing money even with current rents. The elderly looking to downsize could find themselves trapped because the new annual property tax would apply after they sell, making downsizing more expensive than staying put. Anyone currently mid-transaction faces massive uncertainty about whether the rules will change before they complete. And here's the cruel irony in all of this. The policies are supposedly designed to free up the housing market, reduce the transaction tax burden, encourage people to move. But in practice, the uncertainty is having the opposite effect. The market is frozen, people aren't moving, transactions have dropped. The very outcome the Treasury wants to avoid is happening right now because of speculation about what might happen. If a new annual property tax is introduced, it could actually trap people in homes they've outgrown, because selling would trigger ongoing tax bills. If council tax is overhauled based on current values, people in London and the South East who are already stretched might find they simply can't afford the higher bills and can't afford to move either. So what's the realistic timeline for all of this? November 26th is Budget Day. If simple rate changes to stamp duty are announced, they could take effect immediately, potentially at midnight. That's happened before. But the bigger structural reforms, replacing stamp duty entirely, overhauling council tax, introducing a mansion tax, those would require new legislation. Realistically, We're looking at 2026 at the earliest for implementation, possibly 2027 for more complex changes. Council tax reform in particular would be a multi-year project requiring revaluations, public consultations and new laws. It's not happening overnight. In the lead-up to Budget Day, watch for increased Treasury briefings to the press. When they want to soften the ground for major announcements, they leak details in advance to gauge public reaction. If we start seeing very specific proposals in newspapers with Treasury sources attached, that's a sign something's coming. What Rachel Reeves has actually said publicly is no decisions have been made. That's politicians speak, for we're considering it but haven't committed yet. The property market's reaction is already visible in the data. Demand down, sales down, uncertainty up. But here's what typically happens after a budget. Once the uncertainty resolves, once people know what the actual rules are, pent-up demand gets released. Those buyers who've been waiting return to the market. Sellers who've been holding off finally list their properties. We could see a surge in activity in early 2026 as the market catches up on all the transactions that got delayed. Unless, of course, the budget brings genuinely terrible news that fundamentally changes the economics of property ownership. Then all bets are off. The UK property market is in a limbo state we haven't seen in years. Every rumour, every leaked proposal, every think tank report sends ripples through buying and selling decisions across the country. Homeowners are checking property websites obsessively, not looking for their next home, but looking for clues about what the budget might bring. Estate agents are fielding more questions about potential tax changes than about actual properties. Solicitors are being asked to build flexibility into contracts in case the rules change mid-transaction. Financial advisors are seeing a surge in people asking whether they should sell now, buy now, or wait. And nobody has concrete answers because until Rachel Reeves stands at that dispatch box on November 26th and opens the red box, it's all speculation. Educated speculation based on Treasury modelling and think tank proposals, but speculation nonetheless. Here's the fundamental question everyone's wrestling with. Do you act now based on what you know, or wait for clarity on what might change? There's risk either way. If you rush to complete a property purchase before the budget and stamp duty gets abolished the next day, you've potentially wasted thousands. If you wait and a worse system gets introduced at midnight, you've potentially cost yourself even more. If you're a landlord and you sell now to avoid rumoured tax changes, but those changes never materialise, you've exited a market that could still be profitable. If you hold on and national insurance gets slapped on rental income, your returns could vanish entirely. There's no perfect answer because nobody knows what's actually going to happen. Historic context suggests that major property tax reforms take years to implement and are rarely introduced overnight without consultation. The council tax system has been broken for decades, and successive governments have been too scared to touch it. Would Labour really be bold enough or foolish enough to do what Thatcher, Major, Blair, Brown, Cameron, May, Johnson, Truss and Sunak all avoided? Maybe. They've already shown they're willing to make unpopular decisions with the inheritance tax changes on pensions and agricultural relief. What we do know for certain is that the government needs revenue. We know property wealth is largely untaxed and growing. We know the Treasury is actively modelling options for property tax reform. We know the Chancellor has ruled out raising income tax, VAT, and national insurance. And we know that leaves property, inheritance, and capital gains as the main targets. November 26th will bring answers. Some of the rumours will turn out to be true, others will have been nothing but speculation. And whatever gets announced will immediately create new questions about implementation, timelines, and consequences. For now, the property market holds its breath. Buyers are waiting, sellers are watching, landlords are calculating, and everyone's counting down to November 26th, hoping the reality is better than the rumours. Because if even half of what's being discussed actually happens, UK property ownership is about to change in ways we haven't seen in a generation. That's where we stand. 3 weeks before Budget Day, make sure you're subscribed to Property Reporter, because the moment that budget is announced, we'll be breaking down exactly what it means for homeowners, buyers, sellers, and landlords across the UK. No speculation, just the actual facts and how they affect you. Until then, stay informed, don't panic, and remember that rumour and reality are often very different things.